Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
G'day everyone, welcome to the Smart Property Investment Show. It's Phil Tarrant here, editor and also your host. Thanks for tuning in. I've got my regular co-host, Tim Neary from Real Estate Business here. Tim, how you going, mate?
Good, Phil. Thank you. Thanks for having me on the show again.
That's good, mate.
Yeah.
Got a treat for you today.
Yeah.
We're probably going to get a bit academic, but I'm all right with that. We've got Chris Joy here in the studio with us. Chris, how you going, mate?
Yeah, good, Phil.
Mate, I've been looking forward to having you on the show for a while. For our listeners, Chris is a bit of an interesting background. So I know Chris from working within mortgage markets, and Chris was he's been pretty integral over the years in terms of helping to decipher and really understand what's happening in mortgage markets and real estate markets. Chris spent a lot of work. He's worked with 3 of the last 5 prime ministers. Have I got that right in terms of housing policy?
Yeah, I helped advise Prime Minister Howard and Prime Minister Rudd and I guess Prime Minister Turnbull as well.
Most recently. So you might know Chris. He is the contributing editor for the AFR. Chris is an economist, but he's also a fund manager where he works with an organisation called Smarter Money Investments. So lots we can talk about today, and I think the challenge for us is going to be working out what we don't chat about and what we do chat about. But to give you some context, we're recording this podcast a week after Donald Trump has been announced president-elect in the USA. So I thought we'd kick off, Chris, with getting a little bit of insights from you around how the madness that is what's happening in America might play out in terms of how Aussies here in Australia receive money and at what rate for their mortgages. Is there any context at all there?
Yeah, no, that's a really, really good question because, first you got to think about Trump, extraordinary campaign, no one picked it. And the market reaction initially when Trump was elected president was savage. I mean, the US equity market fell 5% intraday, hit its so-called circuit breaker. And everyone was sort of thinking it was going to be very doom and gloom and end of the world. We had a much more positive view. We thought that markets would quickly come to grips with the idea that this guy is really the pure American profit maximizer. He's a moneymaker. He's not a political zealot. He's not a great policy reformer. He's not a sort of raving right-wing lunatic from the religious right within the Republican Party. All he knows how to do is make money, and he's a great salesman and obviously entrepreneur and property developer, which is germane for this show. So on that basis, we felt that once he won the presidency, he would become much more stable, much more rational, much more predictable, and really focus on supporting the economy. And that's what happened in his first speech. So he talked about spending $1 trillion on infrastructure and really boosting economic growth and reducing the regulation of banks. And markets have boomed since, crucially for resi investors. Trump's had a direct effect on long-term Australian interest rates. So we've seen a massive spike, when I say massive, about a full percentage point in the 10-year interest rate here in Australia. So it jumped from about 1.7% to 2.7%. They're rough numbers, not exactly on the mark, but they suffice for present purposes. And that will increase the cost of fixed-rate home loans. So 3-year loans, 5-year home loans, we've seen, for example, the 3-year interest rate in cash markets increase. This is not the borrowing rate. This is the interest rate that the government pays to borrow. That's increased from about as low as around 1.4% to about almost 2%, towards 2%. So we're going to see higher fixed rate loans, and coupled with the current exuberance in the resi market, I think that will mean that the easing cycle is likely over for the RBA. So I think it's unlikely we get further cuts. But Trump, I think, net in summary, is in the short to medium term going to be a positive thing for financial markets. So those interest rates are actually increasing because people are more positive, and they think there's going to be more inflation and more fiscal spending in the US. The US is the biggest economy in the world. That will flow into better global growth and more positive growth for Australia. If you look at iron ore prices up near $80 again, so they've doubled from where they were. Coking coal prices have increased by an extraordinary amount. So everything, I think, economically for Australia right now is looking pretty positive. The Chinese economy is relatively strong, but the key takeaway on Trump is he will likely mean, at the margin, less a lower chance of rate cuts here in Australia. In fact, I don't think there will be any rate cuts. I think the easing cycle's over. And it's more likely that we see hikes sooner rather than later, as in perhaps in the next 12 to 18 months rather than 2, 3, 4 years' time.
So as an Aussie property investor, whether I'm looking to buy my first investment or I have a large portfolio, it's hard to keep abreast of all these different economic indicators which can influence what interest rates are going to do. And you speak very authoritatively about it because you immerse yourself in it every day. Your average property investor doesn't have that opportunity. So looking from across the Pacific into the US, what should I be worrying about that will influence how I might shape my property investment decisions coming out of America? Is there anything really that tangible I need to concern myself with, or should just be listening to what the RBA is doing and looking for those little indicators that rates might start to rise because of what I might read in the media or on your column of the AFR or whatever? What's some real good takeaway there?
Yeah, it's slightly technical, but if you could do this, what you should do is try and you can get off the ASX's website. If you go to the Sydney Futures Exchange, you can get basically the 3-year interest rate for a government bond and the 10-year interest rate for a government bond, and they are all important for what's happening in Aussie resi. And the reason being is that 3-year interest rate is simply financial markets or traders' best guess of where the RBA cash rate will be in the next 3 years. So if you think about it as a property investor, what do I care about? If I thought there was going to be a substantial increase in interest rates over the next 3 years, I probably wouldn't be buying. I'd probably be looking to defer that purchase and pick up property when prices are falling, because prices will fall significantly if rates increase significantly. So that's going to be your best proxy, your best kind of pulse for global markets. And that 10-year rate, the 10-year government bond yield here in Australia, is the market's best guess of where rates will be over the next 10 years. So a few months ago, that 10-year rate, as I mentioned, was down around 1.7%. The RBA cash rate right now is at 1.5%. And so what that means is the market was saying we're not going to have any rate hikes for the next 10 years. Suddenly it's jumped up to 2.7%. So the market's saying, gee whiz, we're going to get more than a full percentage point or more than 4 RBA rate hikes, standard rate hikes, 25 basis point rate hikes over the next year. So if you want to really kind of get the best of what global financial markets are thinking, it's just the 3-year government bond yield and the 10-year government bond yield on the ASX's website, or email us. I'll get in contact with you, Phil, and we can kind of send the readers a link.
Okay, I'll do that. Let's stick it up on the site so they can follow through to it.
For sure. And on what you should be worrying about, I think the first thing is, obviously, if Trump does prove to be the kind of completely irrational, mercurial, capricious, sort of unpredictable dude that folks fear he might be. I don't think that's the base case. I think he'll be, again, he's a moneymaker. He'll be focused on maximising economic growth. But any evidence that he's running way off the rails, I think, would be disturbing. That's really the only major negative. People talk about trade and they talk about foreign policy. I think he'll be, he'll be a conservative on foreign policy, which means he'll take a tough stance on certain issues. And yes, on trade, I think he'll probably build the wall along the border with Mexico, but he's now talking about it being a fence rather than a wall.
And only bits might have a fence on it, so yeah, that's already coming down.
So, but the key thing for property investors is interest rates. That's really the be-all and end-all. And if you see any unusual kind of interest rate levels, that's what I would
start asking questions.
Yeah.
So for you, we're not going to see any more rate cuts here at home. You think that's done and dust with the RBA? They're not going to come down any further?
So I think the consensus view is either one more cut or no move. I think the RBA, so I speak to the RBA relatively regularly, and I think the RBA has been very dovish, which means they've been inclined to want to cut rates. So we had a May cut, we had an August cut. I think they were kind of gearing up for potentially more cuts, but they've been really blindsided by the housing market. What has shocked them has been the really rapid re-acceleration in house price growth in Sydney and Melbourne, the rapid increase in auction clearance rates. In August, after they cut rates for the second time this year, the RBA said auction clearance rates are lower than they were 12 months ago. Sales turnovers have dropped off a cliff. The housing market's cooling. There's nothing to see here. I wrote in the Financial Review in my column that I thought that was bullshit. And actually that auction clearance rates were higher than they were 12 months ago. That's proven to be absolutely spot on. That house prices were accelerating. The RBA claimed that house prices fell in July. They didn't. They rose significantly. And over the last 2 quarters, and certainly over the last quarter, as in the last 3 months to November, house prices nationally have been rising at a double-digit rate, but certainly in Sydney and Melbourne they've been sort of exploding at strong double-digit rates. And the RBA assured Parliament and the community that the May and August rate cuts would not re-accelerate house price growth. They said this categorically in testimony to Parliament. And again, they've been proven wrong, because we know, last weekend auction clearance rates in Sydney and Melbourne were both around 80%, way above circa high 50% levels in Sydney and Melbourne this weekend last year. So I think rate cuts are off the table, and the unemployment rate is only at 5.6%. Why is that important? Basically, the RBA has said recently they think that when the unemployment rate drops to 5%, which is not far away from 5.6, we'll be at a level where we will start seeing wages growth again. So significant increases in wages. We haven't had that to date. That will basically, I think, be a trigger for rate hikes. So another thing you want to be watching for as a property investor is, when does that unemployment rate come down to 5%? So 5.0 rather than 5.6, because rate hikes will absolutely be on the table. And I'm convinced, we can talk about this, that will mean price falls for property.
And so is that going to happen? Are we going to get to a point where we've got 5% unemployment?
Well, the jobless rate moves around. It's come down from 6.4% to 5.6%, and it can move very quickly to 5.0. And my personal view is yes, that the unemployment rate will keep on falling. The RBA is not going to hike rates. Listen, I bought a property. I sold in Bronte here in Sydney in November last year for more than double what I paid 3 years prior. We've been renting for the time being, and I've just bought in the eastern suburbs on the basis that we'll be able to build for 12 to 18 months and then sell as owner-occupiers before the first rate hike. I'm hoping I'm right. So I'm hoping...
A bit on the line there.
Yeah, it's a bit borderline. But I think it's quite likely the unemployment rate will drop to 5% in the next 2 years. And as we move close to that 5% boundary, the RBA will get more and more edgy, because the 1.5% cash rate is the lowest ever observed in Australian history. Where in April 2009, they cut the cash rate to 3%, and that was meant to be an emergency low. Listeners probably don't remember, but in August 2008, the cash rate was at 7.25% in the middle of the GFC. So there's a lot of upside, and this cash rate is highly stimulatory, and it's obviously creating a lot of action in the housing market. So I think, when rates rise and mortgage rates start normalising, I think we're going to see a correction in house prices, and I would not want to be... I would try and minimise personal exposure to that event and then try and capitalise on it, because I think house prices currently, right now, they look like they're a solid 25% overvalued in Sydney and Melbourne. Brisbane, Adelaide and Perth, very different. Perth property looks cheap. I know people that are moving to Perth to buy property and trade out of the Sydney market, and who are making that switch, which makes a lot of sense if you can do it. But if prices fall 15 to 25%, there's going to be a little bit of mayhem, and and the housing market's a bit like a super tanker. Once it moves in one direction, it tends to move in that direction for a couple of years at least. It's not like prices fall overnight, but they'll continue falling for a long time. So that'll present opportunities.
So what sort of hikes are we going to need coming out of the RBA and the consequent increase in mortgage rates from the banks to start changing the dynamics where we see price growth becoming negative? Like, are we talking one hike at 25 basis points, 2 hikes, 3 hikes? Where are we? Because as a property investor, and you mentioned this, that there'll be a lot of pain, but then there'll be people capitalising on probably a lot of people's misfortune, because price drops going to happen, et cetera, et cetera. So what's it going to take in terms of hikes to see a decline in property values here in Sydney and also in, I guess, the Melbourne marketplace?
I think 3 to 4 hikes, definitely. Possibly
in what period of time?
Any period of time.
Okay.
But 3 to 4 hikes, definitely. 2 to 3, I think, is a reasonable base case. So after the second or third hike, I think prices will start falling. The market is more sensitive to interest rate changes than it ever has been before. In 1990, if we look at the value of housing debt relative to household incomes, debt was at about 60% of incomes. Today, it's at about 186% of incomes. And there's lots of... So the first point is we've had this massive acceleration in housing debt relative to our incomes, which means we're much more sensitive to interest rate changes. But we've had an interesting precedent. So the RBA cash rate was crushed from 7.25% in August 2008 to 3% in April 2009 in the GFC. And then the RBA brought it back up to, I think, 4.5% or 4.25%. I think it got back to 4.5. So that was 150 basis points of increases, or 6 standard RBA rate hikes. So we had 6 hikes, and the last hike was in November 2010. And you might remember in November 2010 they lifted by 25 basis points, and the banks, being the greedy bastards they are, that's said in jest, they added 20 basis points on. So it was like a double tap, a double hike. House prices across Australia fell about 6.5% peak to trough from November 2010 to May 2012. So for the best part of almost 2 years, prices were declining. And you might remember in 2011, 2012, the market was really weak, and you could pick up amazing bargains. And I think we're going to see a repeat of that cycle. The only difference this time is that obviously we have the Asian bid, which I think will be secular insofar as it'll be a permanent feature of our market. But there's personally no doubt in my mind that prices are going to fall. They're going to fall significantly. I think we'll all be fine. No bank's going to go bust, but we're looking at a kind of, I think, realistically, somewhere between a 12.5% and 25% drop in house prices over a period of time across the board. And when I say across the board, mainly in Sydney and Melbourne.
So I'd like to get onto the impact of Asian investment in terms of resi property. But before I do that, I was hoping you could explain to our listeners. So you're talking about a price drop because of rising interest rates. What is the practical dynamics of that? So is it because as rates go up, people are placed under greater pressure to meet their repayments on their loans, and therefore there is household stress, and because of that household stress, people will start to sell assets, and because there is that stress, those assets will get sold at lower rates than what they typically would be getting. Is that pretty much the dynamics of why and how prices will go down?
You can look at this several different ways. One way to think about it is that the current cash rate is at 1.5. So let's say they run with 4 hikes. Now, the context here is the banks are going to be under pressure to increase interest rates, irrespective of whether the RBA hikes, because the banks' returns are shrinking, because the regulator is forcing them to hold more capital and reduce leverage. The 4 major banks basically have the equivalent of 5% equity deposit on their balance sheet, and they have 95% debt, which means they're leveraged about 20 times. In the same way, if you put 5% equity down when buying a home and you used a 95% loan. And so as they're being forced to use more equity and less debt, their returns are falling, and they're going to try and further increase home loan rates, investment and owner-occupied. That is inevitable over the next 2 years. So that's point one. Point two is cash rate's at 1.5. So let's assume the RBA goes 100 basis points. So the cash rate goes to 2.5. That means you're going to get term deposit rates of potentially between 3.5% and 4%. If you can earn 3.5% to 4% net with no transaction costs, risk-free, with daily liquidity, that will beat most of the yields you get gross in resi today. So there'll have to be a repricing, a resetting of valuations. The second point is that more technically, if you look at the housing market today, and if the RBA cash rate stays at 1.5% forever, the mathematical analysis is that, the way you do this, if you took the median house price in Australia in 1980, and if you just grew that house price in that median price in 1980 by disposable household incomes, and then you also adjusted it by any changes in interest rates, assuming a fixed loan-to-value ratio, so a fixed 80% loan-to-value ratio, what you find is that in 2016, the change in interest rates, as in the drop in interest rates, and the growth in household incomes, suggests that the current values we see today are absolutely spot on fair value. The housing market is well priced, if and only if you believe the RBA cash rate at 1.5% is the right level, which is the lowest it's ever been. The average RBA cash rate has been around 5% over the last 20 to 30 years. So if that 1.5% is wrong and it needs to rise, most economists think somewhere between 3 and 4%, which means we've got many more than 4 standard rate hikes. We've got, again, 150 to 250 basis points worth of hikes. If that happens, then current housing looks about 25% overvalued. So they're the numbers. But the simple way to think about it is, why would you buy an investment property giving you 3 to 4% gross, which after stamp duties, agents fees, maintenance, depreciation, blah 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 blah, is like 2.5% best case? Why would you get 2.5% when you get 3.5 to 4% in cash? So it's just, I guess, an opportunity cost issue.
And that's from a yield perspective. So in terms of a devaluing of property prices upwards of 25%, for those people that purchase those properties when they're 25% under where they were at X period of time, that's where the opportunities lie for property investors. So it's good to be cashed up if you can pick that spot when that happens.
Yeah, exactly. And you know what? This is all quite predictable. Housing markets are very predictable. Which is why we've got it right, frankly, for so long in terms of the year-on-year growth rates. But in 2008, I used to debate this famous academic called Steve Keen, who said house prices would fall 40 to 50%. I said no, 5 to 10% tops. They fell, I think, 6% that year. We thought house prices would rebound quickly. They did very quickly. So we had double-digit growth in 2009 and the first half of 2010. And we forecast double-digit growth over 2013, 14, 15, and then strong growth this year. And that's what's transpired. I think the key for investors is, personally, I would be looking to exit the market over the next 1 to 2 years before the first hike starts. Obviously, if everyone acts on this advice, then this could become a self-fulfilling prophecy. But and then I'd be looking to capital. I think you'll get tremendous opportunities. And it'll take some time. You've got to be patient. You've got to wait for the rate hikes to fully flow through. But to capitalise on the valuation change when prices do fall, 10 to 25%. You mentioned, Phil, the point about stress. So yeah, another contributing influence on this whole cycle, and there will be cycles. And what we're seeing is housing is getting more volatile because there's so much more leverage, so much more debt. But another contributor will be, I think, if you get more than 100 basis points of rate hikes, you will have lots of borrowers who can't afford to repay their loans, even though they think they can. And there'll be just lots of, the marginal buyer, the math won't stack up. And I think what's interesting is the market today, there are many more investors than we've ever had before. So we know that roughly 40 to 50% of the new housing finance or mortgage approvals are going to investors. We've got the SMS investors who have never been there before. We've got the Asian buyers who were never there before, and they're investors. And Asian investors tend to be very mercenary, very ruthless, and very good traders. So they're likely to cut their losses potentially quite quickly, as are I think, SMSF owners. So at the margin, I think the minute house prices start falling, you're going to see investors, more so than they have in the past, cutting their losses. And that will sort of amplify the price change. I want to stress, though, I'm actually very bullish on housing over the medium, over the next 10, 20, 30 years. The fundamentals are very strong. There's strong population growth, strong immigration. I think the China and India are the biggest sources of new migrants to Australia now. 30% of us were not born, so 30% of residents were not born in Australia. The economy is in good shape. The RBA will be raising rates because of economic strength, not weakness. But I think that there needs, like all financial markets, the share market fell 50% in 2008, but we didn't all get rid of our equities. I mean, people still held equity exposures. So like all markets, the resi market is well overdue for a little bit of a reckoning, but it doesn't mean that it's not a good asset class. We've just got to try and time our way into the asset class. I think timing in resi is crucial. I think this idea that you can just blindly hold onto property and ignore the cycle is madness.
And Chris, you were talking about cycles, and obviously it does move in cycles. Is there any way to know how long the cycle is going to last before it turns again? Is there any precedent in history that we've seen we can look to?
Yeah, that's a really good question, Tim. The first thing I'd say is the Australian history, as far as resi is concerned, is probably a very poor guide, because we've just had this long, for the last 30 plus years, we had a long, never-ending bull market in residential prices. House prices in the 91 recession didn't fall across. If you look at the ABS house price index data, it rose 2% a year in 1990, 91, 92. And they only fell 6% in 2008. The biggest fall in house prices ever in Australian recorded history was between November 2010 and May 2012, when they fell 6.5%. And nothing was really happening then. That was a function of the RBA raising rates and the fact that at that point we had accumulated a lot more debt. I think this cycle will be sharper and shorter than what we've seen in the past. So I think you'll see prices fall more rapidly than people expect. I think the adjustment, because we get now, like CoreLogic actually built this index, produces a daily house price index. It's the only index of its type in the world. I should say I worked as part of a team of PhDs who created that index, and I was managing that team. But so I think you'll see probably a 1.5 to 3 year correction in prices. It sounds like a long time, but it's not like a multi-decade sort of Japan or Germany style in the post-war period in Germany, and then the 1990s and 2000s in Japan. I think you'll see a 1.5 to 3 year correction, and then I think the RBA will cut rates. So I think what will happen is, as soon as prices fall materially, the RBA will stop hiking or start cutting, and so it all becomes a bit circular. And I think as soon as the RBA kind of takes its foot off the pedal, and prices reset, I think you'll see some reasonable gains. And the great thing about resi is the heterogeneity, because as we all know, if you really study your local area market, you see prices, like buyers pay way over the odds, but equally there are folks like, I just bought a property, I could be careful what I say, but there was something wrong with the property, and in today's market it sat on the market for 1.5 years.
Brilliant property to buy then.
Yeah, and it was a great property, big block of land in a great street, facing north, great development potential, but there was this one particular issue that folks couldn't get comfortable with, and I did my homework and I could get comfortable with it, and you remove that issue and you've made a lot of money. So I think that you do your due diligence. You've just got to spend, my view is, you've got to spend at least 6 to 12 months kind of in the market, looking at everything that's trading, to both kind of fine tune your valuation antennae, and then also to understand the rhythms. Like, Vaucluse, to take one suburb in the eastern suburbs, is a fascinating one. It used to be it is a very expensive suburb. But if you look at the number of listings coming on from Vaucluse, massive, a tsunami of supply, because people can't now cope with the congestion driving from Vaucluse to the city. And Vaucluse is being choked by all the development in Bondi, and all the development in Double Bay. And those roads, there's no infrastructure. They can't expand the roads. There's no railway. There's just no way to fix those congestion bottlenecks. So that's the sort of stuff you need to understand, all those nuances in your local areas.
Yeah, and it's comforting to hear that, and we know that about property investment, that it's this interconnectivity of it. It's also comforting to hear sort of economically the fundamentals are sound and robust.
Absolutely. Like, again, over a 10 to 15 year time frame, Australia, the Economist magazine refers to Australia as the wonder down under. Because we haven't had a recession since 91, like it's the best performance of any OECD economy. And I think we have very, very good reason to remain optimistic. But we need to understand that this is an asset class. Resi is an asset class. It's traded. There are many more investors than there used to be. You're going to see more price volatility. You're going to see prices fall. But again, that begets opportunity for the smart investor. I desperately want to see prices fall, hopefully well after I trade out of my current place, because I'm actually really excited by the prospect of picking stuff up that's cheap. Because if prices on average fall, say 12.5% or 15%, you'll see in different suburbs prices fall literally 30 to 40%, perhaps even more. You saw this in 2008, 2009, in Portsea, in Palm Beach, in Toorak, in Point Piper. I mean, prices were slashed 40%.
Premium locations.
Yeah, premium markets, much more volatile markets.
Yeah.
Actually, one little piece of advice, we did some research on this subject. We looked at every purchase and sale of every single home in Australia since 1990. And there's this myth that if you invest in luxury markets, you're going to get better returns. But if you think about it, a luxury market is an expensive market which has already had its run up in price. So it's actually likely that in the past the luxury market performed really well, but now it's run its course. In the future it may not deliver higher returns. And we actually found that when we looked at the performance of expensive markets and actual purchases and sales, so not looking at a house price index, actually looking at guys who have bought and sold the same property over time, we found that you're better to buy in median priced areas which have the most demand and appeal to the biggest market of buyers. So you're better to target those mass markets that are going to be future growth areas that are likely to outperform in terms of price appreciation. And
I think you made a very important point, Chris, in that when you look at the evolving demographic structure of Australia and Australian economy with migration, a lot of these different indicators are saying that is there going to be population growth? Yes, there is, big tick. Where is that population growth going to happen? It's going to be Sydney, Melbourne, Brisbane, bit in the Gold Coast. To use a term that Bernard Salt uses, calls it the Dubai effect, right? People parking their cash in nice, safe locations, and that's going to be in our capital cities. So you're going to see that growth in these locations, which is a big uptick for property investors. The point I would make, and we've got to wind up because we're running out of time, is that there would appear to be a sort of a bit of a two-speed market, or there's markets within markets, but it's a bit of a two-speed market. So we've sort of rested heavily on the dynamics of what will and may happen in Sydney and Melbourne based on the dynamics that you've spoken about. And I think they're very sound clarity to your thinking. And I think all of our listeners should consider that when looking at locations to invest in right now. But I would also say, and there's a point that you picked up, that it's always a good time to invest in property if you're investing in the right property in the right market, and you can actually afford to hold that that property and service it based on any considerations that might happen in terms of growth. So you spoke about Perth, you spoke about Brisbane and some other areas. So there are opportunities in today's market for the astute investor. It's just about really understanding where they are.
100%. Like, I completely agree with that. I say the same thing about the share market. The share market looks very expensive, but within the share market, there are always going to be opportunities, and property is like an extreme variant of that. We've got 9 million homes in Australia, and there are always idiots selling stuff for ridiculous prices, and it obviously works on the the high side. That market is kind of often grouped by fear and greed. And there are also often circumstantial opportunities for the astute buyer that can pull the trigger quickly. So, be it a person who's had a change of job or some sort of financial stress and they have to sell immediately. Just quickly on the point about population growth, I completely also agree that, so I've had this long-running debate with the government on population growth. In 2002, I think it was, I've written an AFR article, again, if anyone's interested in this analysis, we can shoot them the links, but I showed that in 2002, the ABS was projecting that we'd have 24 million people living in Australia by 2050. Well, guess what? It's 2016, we have 24 million people living in Australia. This was back when they were trying to encourage family fertility. So, the baby boom, Costello and, Turnbull were trying to encourage families to have more babies because they were actually worried about the population shrinking. Now, every year since, the ABS has basically underestimated population growth. The latest cut in the Treasury's intergenerational report had the 2050 number at around about 38 million people, and I still think that's light. So I think we're more likely to have 40 million people. So housing bears often talk about Japan. House prices fell in Japan for 20 years, and the same thing could happen in Australia. What they miss is that Japan's population has been shrinking since 2000, and the Japanese government forecasts that the Japanese population will be 25% smaller in 2050. So our population is going to be 60% bigger. We're going to have 8 to 9 million people living in Sydney and Melbourne, and I don't mean to bash Bernard Salt, but I think he was kind of slow to these trends back in the day when I was arguing over them, almost 10 years ago, because everyone was worried about, again, Australia's population contracting. Whereas, I think we're an immigrant nation, we're a multicultural society, and I think that will always be the case, and that's very positive for Resi. And I also think we're becoming the destination of choice, to your point about the Dubai effect. We're becoming the destination of choice for middle-income households right across the Asian region, but particularly in China and India, and that's not changing. And what's actually happening is you're getting positive network effects whereby there are so many Asians now living in this country that they're building their own communities, and there's a greater incentive for their comrades in China and India to move here because they've got those positive community benefits they can now capture. I see it at my son's school, lots of Asian kids and first generation families who struggle even to speak English. So I think net that's a long-term positive for the market.
It is. So we're going to wind up, but I just want to pick your brain on one more thing, Chris. And it's a point you made earlier on that as and when this dynamic we've been talking about in terms of a drop in property prices and therefore your yield, so your return on your investment, smart investors will be looking to immediately capitalise on lower prices, but they'll also be thinking about how they can make their money work smarter for them at a present point in time. So there's two ways you can make your money work for you smartly in property. One is if you've got cash kicking around, if you're saving for a deposit, you can chuck it against it in a offset account and reduce the amount of money you pay on interest, and you might be getting 4% maybe upsides on that. The other way you can look at doing it, and if you're looking to capitalize on a fluctuating market with prices going down and you need liquidity, is that you can keep that money in cash. And I know you work with a fund manager, and you know this is something you deal with every single day, as in getting the best absolute return on your cash. Can you give me just a bit of insight in those dynamics?
Yeah, sure. So I'm one of the portfolio managers at Smarter Money Investments, and we offer an active cash solution where we basically invest our capital, and we're running around $700 million today. We invest our capital across all the bank's deposits, but also their bonds. So when you lend to a bank, also when you invest in a deposit, you're lending to a bank. You're basically a bank to the bank. And if you're going to lend to, Macquarie via their cash management account at circa 1.5%, that's really cheap money for Macquarie to borrow. Whereas you can invest in the Macquarie senior bond and get closer to probably 2.6, 2.7%, and then the major banks at Macquarie and the regional banks offer bonds that are currently paying between 4 and 4.5% interest. So that's what we do. We diversify across the banks through their deposits and their floating rate bonds. And over the last 12 months, we've returned across our products around about 4% after fees. We offer daily liquidity, and we have actually a lot of property investors who have sold out of the market. They've got that windfall. They don't want to jump back in. They're happy to rent. Frankly, that's exactly what I did. So they want to sink that cash, but it's obviously into something that's safe, that's going to preserve their capital, but also something that's going to generate a decent return. It's very hard. Again, cash management accounts paying 1.5%. You're lucky to get more than 2.4% in a term deposit these days. So it's very hard getting decent rates of return. So one of the questions is, how do you keep pace with the market? How do you preserve capital, and how do you earn decent returns? So that's what at Smarter Money Investments through the Smarter Money Fund we do.
Okay, so you can put your cash on offset and it's tied up there and you can use it, or you can bit of diversification, put your money in a fund like this, and you can draw down on it as quickly as you want. Yep.
Correct. Yeah,
okay.
We're diversified across over a dozen Aussie banks. The offset is going to be probably the best place for most folks who have debt, but for those who have sold out of the market and have no debt, they obviously, the offset's not relevant to them.
You just park your cash and leave it there and strike when the iron's hot.
Correct.
I like it. Chris, mate, really appreciate your time.
Thanks
for coming in.
Thanks, Tim.
Nice one, mate.
Thank you, Phil.
I think we've summarised some of the points Chris has made during the course of the podcast, but a couple of things I would say to investors, and this is quite an academic conversation we've had, and I think it's important to have those conversations at times. Property investment just isn't all about trying to find under market value properties and hopefully they're going to go up in value or can manufacture some equity over time. I think it's really having a true understanding exactly what money markets are doing and how that's going to influence the way in which that you secure financing for your property and how that might change over time. So smart investors understand the upsides with investing, but they also should be considering the what if scenarios, what might be happening if interest rates are higher, how that might influence the level of repayments that you're making, how that's going to place pressure potentially on household finances, all these type of things which we spoke at length in. So Chris will come back on the show. I've asked him to come on again in a couple of months' time, and maybe we can catch up and see where we are with this type of stuff. But in the interim, remember, go to smartpropertyinvestment.com.au. We've got plenty of stuff written about what's going to happen to interest rates, and I'm sure Chris will put something together for us, and a couple of those links that you mentioned as well to those resources that you outlined. So we'll get that on there, and get in contact with Chris if you've got any questions for him.
For sure.
You can contact me, editor at smartpropertyinvestment.com.au. We're also on all the social stuff, Facebook, Twitter. You can follow me on Twitter at Philip Tarrant. You can follow Chris on Twitter at
CJoye, that's CJOYE.
There you go. And make sure you read his column in the AFR every single week, isn't it? I think we'll talk a couple of times a week.
Every week,
cool.
yeah.
All right, good one. I've got to sign off. Thanks for tuning in. We'll see you next time. Bye-bye.